It's a new month here at Henssler Financial, and we found three important things to focus on in the market this month. Number one, terminal rates. Thus far in 2023, U.S. growth has been stronger than expected. The economic surprise index is trending positively, and the calls for a recessionary slowdown into early 2023 appear premature. This, alongside a stubborn inflationary backdrop, continues to move the expected federal funds rate higher. The question remains, when will the Fed stop hiking? The last couple of months have seen what is the so called terminal rate, or the point in which the Fed stops hiking, reach 5.5% from 5% prior. With inflation still above short term rates, we will have a close eye on Fed policy and guidance, as it seems key to financial conditions into the middle of the year. Number two, housing market. Some of the activity measures in housing have seen a moderate recovery, namely the National Association of Home Builders Confidence Survey rose in back to back months into February, and new home sales saw a gain in January of 7.2%. However, elevated mortgage rates continue to wreak havoc on market momentum. According to Black Knight, over half of U.S. mortgages were written in 2020 or later. As economic data remains strong, the average fixed rate mortgage from Freddie Mac remains at roughly 6.5%, with the worst housing affordability in a generation. This compares to a rate of roughly 3% as recent as late 2021. Depending on the market, home prices have also begun to slip. At the broad level, NAR data showed a 0.7% gain year over year in prices, but some of the hotter metros have already seen declines. Number three, labor market. As part of the broader picture, despite large scale tech sector layoffs, the labor market remains strong. In a few days, we will get additional indications on payrolls and unemployment, but the real time data shows more and more people are working and roles are hard to fill. The ISM report showed favoritism towards attempting to hire rather than reducing employment. Wage gains and unit labor costs remain stubbornly high, with Q4 of 2022 seeing 6.4% gains. With all the moving parts, it's difficult to predict where inflation lands, but if the labor market stays this tight, the runway for growth could be longer, albeit with a harder task for the Fed in taming inflation. And that's been your Market Minute for the month of March. Thanks for listening.